Let's take a moment to reflect on what's really happening in global markets right now. Jamie Dimon recently said that geopolitics is the biggest market risk, and sure, if you're trading headlines, that might feel accurate. We're in a world where headlines come fast: Taiwan tensions, Ukraine, energy disruptions, new tariff wars. But if you zoom out and think like a long-term investor, that's not the only risk. In fact, that's not even the most urgent one. We've entered a new financial regime, one where inflation isn't going back to 2%, rates aren't going back to zero, and government debt isn't just a footnote, it's the main character. So, how are the top investors navigating this? Here's how we see it. Let's start with our portfolio. Not much has changed in structure, because we didn't build it for the last cycle, we built it for what's coming right now. We own 8 core positions. These aren't just good companies. They're exceptional businesses, dominant in their categories, scalable, and built to endure. And yes, we've got a small position, about 1%, in Fannie Mae and Freddie Mac. That's more of a high-conviction option, a way to bet on the possibility that the US government finally releases them from conservatorship, but it's not central to the strategy. Our real focus is owning high-quality, high-moat businesses, and hedging selectively where the risks are most asymmetric. So what are those risks? 2 big ones right now: energy prices and the Treasury curve. Let's talk about the long end of the yield curve, and why we think long-dated interest rates are still heading higher. This is a position we've been in for over 18 months now. We called it early, and the thesis is still intact. Yes, we've made real gains, nearly $3 billion just on 2-year rates. But here's the thing, we think there's more to come. Why? Because the bond market is broken. Look at the dynamics right now. We're likely heading into another government shutdown. When that happens, all those government agencies that release economic data, they go dark. That means the Fed loses visibility, investors lose visibility, markets become more reactive, more volatile. At the same time, look at the demand side for treasuries. China selling, Russia selling, Saudi Arabia selling. Meanwhile, the US is running massive fiscal deficits, and the Treasury is flooding the market with supply, hundreds of billions of new paper, and you're being offered, what, 4.7% on a 30-year Treasury? It doesn't add up. We're talking about locking in a fixed return from a country whose inflation could average 3.5% or more for years. Would you lend money at 4.7% to someone who's inflating away your purchasing power at 3.5% annually, for 30 years? Let's go even deeper. We had a unique window, post-2008, where the entire financial system was bent toward fighting deflation. ZERP, QE, trillions in fiscal spending. It created this illusion that cheap capital is permanent, but it wasn't. It was a one-time reaction to a crisis, and now the system is snapping back. Inflation has broken out. Fed can't save you with another QE cycle without risking political and monetary credibility, and the US balance sheet, it's stretched to the limit. Over 1/3 of US debt is rolling in the next 12 months. Think about that. 1/3 of a $34 trillion debt load is going to be refinanced at significantly higher rates. That's not just a technical detail, that's a generational drag. So what does all this mean for equities? If you think bonds are broken, how can stocks work? Here's the key: you need to own companies with pricing power, businesses that can pass through inflation, businesses that aren't crushed by rate volatility, businesses that act like royalty streams. Here's what we hold, and why. Universal Music Group, a royalty on human culture. Every stream, every YouTube video, every TikTok track, they get paid. Google, a royalty on digital ad intent. Search is still the front door of the internet. Hilton, a royalty on business travel and hospitality. Restaurant brands, Burger King, Popeyes, Tim Hortons, all high-margin brand-driven franchises. These companies thrive in a 3% inflation world. What kills companies is volatile inflation, or 8% spikes that destroy margin planning, but steady inflation, that's actually good, as long as you can raise prices faster than costs. Let's talk valuation. Most investors are still using a 2% discount rate in their heads, but 2% is dead. We've always used 9 to 10%. We built in a margin for risk, and now that's paying off. So no, we're not selling because the 10-year broke 4.5%. We're buying companies that we'd still own at a 6% risk-free rate. And that brings us to one of our most interesting recent buys, Alphabet. Yeah, we bought in when everyone was panicking about it. I remember when ChatGPT launched. Google fumbled. The demo was weak. Everyone thought they were behind. The stock dropped to 15x earnings for Google. We couldn't believe our luck. To be clear, Google has been investing in AI since 2014. They own DeepMind. They've hired tens of thousands of top engineers. They design their own TPU chips. They have incredible training data from Search, YouTube, Gmail, Maps. They just weren't loud about it. Meanwhile, OpenAI comes out swinging, and the market assumes Google is dead. That's not how this works. So we bought, and then we bought more in the $120s. Today, Alphabet is our second largest holding. Now, is the AI race over? Not even close, it's just starting. Google has integrated AI into Search, Ads, Docs, and Android. They're rolling out Gemini, their next-gen foundation model. They have the infrastructure, the data, the capital, and most importantly, the distribution to be a leader. Full stop, and we're thrilled to have gotten in when everyone else ran away. Let's close with this. This is a new market regime. Geopolitics might get the headlines. The real shift is macrostructural: inflation, debt, rates, deficits, AI. If you're still investing like it's 2015, or even 2021, you're going to get left behind. We think long-term, we think in decades, and we think this is one of the most exciting environments to own great businesses. because the herd is confused, and confusion creates mispricing. This is when you want to own the next decade's winners. We believe we already do.